Thanks everyone for joining us. This is our webinar number 3, and we have two great panelists today. My name is Kevin Bidencap. I'm going to be the moderator. I am a co-founder of Tortuga Wealth Management, and we have two great panelists. With us today is an estate planning attorney, someone that we've worked with in the past, and he's really excellent. His name is Eric Harris. He's a co-founder of Pacific Coast Legacy Partners, LLP. From 2010 to 2024, Eric was the principal shareholder of Hofer and Harris in Redondo Beach. And now he is with the new firm, Pacific Coast Legacy Partners. So we're super excited to have Eric with us. He's a wealth of knowledge. And Angela and I have both known Eric for quite some time. Eric is board certified in estate planning, trust, and probate law by the California State Board of Legal Specialization since 2012. He's a member of the LA County Bar Association, the South Bay Bar Association, and past president of the South Bay Estate Planning Council. He's also the past co-chair and current member of Professional Advisory Council at Torrance Memorial Medical Center, and a current member of the Professional Advisory Council at Cancer Support Community South Bay. So Eric, we're so happy to have you with us. And our second panelist is Angela Park Sheldon from Tortuga Wealth Management. Angela is a certified financial planner. She's also an accredited estate planner. The acronym for that is AEP. She specializes in advanced estate planning, overseeing the entire financial planning process for clients with an emphasis on multi-generational wealth transfer planning. She's a founding member of Tortuga Wealth Management that she founded with myself in 2010. Angela obtained her CFP in 2006 and other advanced certifications in 2022. Angela is a member of the South Bay Estate Planning Council. She's an executive member of the Trinity Care Hospice. She was a financial advisor and retirement planning specialist with Citi Smith Barney and Morgan Stanley starting in 2001, going back to 2001. So quite an extensive career already as a financial advisor. Let's look at what our agenda items are going to be today and what we'll be discussing. And we just thought we would throw this up there. That's going to be the last slide that we'll have for today's webinar, but we thought it would be a good idea to just walk you through briefly on each one of the kind of items. And we may hit them, one at a time, or it might be, we might skip around a little bit, but the first item is just a brief overview of strategies for collaborating with wealth management and the estate planning process. The second is potential problems. What can occur, or what sort of things happen that can create inadequate planning on the client's part, and how we can attack that. The third part is how to minimize taxes. A lot of estate planning has to do with not only asset protection and protecting for your loved ones, but also minimizing taxes. It's very important, and people are always excited to hear about that. And then we'll talk about this sunsetting of a policy that happens in 2026. For people that work in wealth management and estate planning, this is one of the most talked about items. It's what a lot of people are putting strategies in place for right now to deal with this potential sunsetting. And then fifth is protecting assets via estate planning. That is probably one of the most important items that we'll discuss today. And then lastly, best practices. And we'll end the webinar with a question and answer session. And so what we're going to shoot for is to speak for about 45 minutes, and then we'll allow 10 to 15 minutes at the end for questions. If you have questions, I believe there's a chat portion on the webinar that you could ask along the way. So that would be a great way to start. Okay, let's get kicked off on the webinar. First, I wanted to ask Angela, can you walk us through basically the relationship with the financial advisor or wealth advisor and the estate planning attorney, how that looks like, how they collaborate?
Yes. So Eric Harris is a great partner for us. And, a lot of times as a wealth advisor, we are having to work with estate planning attorneys just because of all the different trust documents that need to be drafted up, all the different strategies that we need to collaborate on. For example, recently we were working on a particular family, and one of the ways that we were able to save this money or save this family money is just by getting a little creative in encouraging the father, for example, who is currently unmarried, to remarry his ex-wife. They have a good relationship, so that their daughter would be able to inherit a lot of the family assets without having to pay estate taxes on it. So that's just an example of some of the things that we might do collaboratively to work with our clients. And so that's just an idea of what we do beyond just traditional estate planning, where we will work with someone like Eric, who I know is very well versed in all sorts of different estate planning manners to get to the right goal and to find the right solution for our clients together. So, we'll, on our side, we might be looking at things more on the financial level. Like maybe we'll see if a client really needs to take all that RMD, for example. RMD is a required minimum distribution that someone over the age of 73 now might need to, or they would have to take that as per IRS rules. And so maybe if they don't need all of that, we might encourage them to do something like a QCD, a qualified charitable distribution, as part of their estate planning, one of the tools in their estate planning belt. So we really do a lot of different things that are very complementary.
Thank you, Angela. So Eric, from your point of view as an estate planning attorney, how does that relationship look from your side? And what do you get out of working with the financial advisor? What do you look for, from them when they bring in a new relationship?
Well, first of all, thank you, Angela and Kevin, for inviting me to speak today. And yeah, I get really excited when I have clients who have good investment advisors, and I really view the wealth or investment advisor as the financial quarterback of that person's financial life. And one of the reasons why is because that person usually sees the big picture. They're in contact with the family, with the client a lot more than the attorneys are. They're even in contact more with than the tax accountant, who you're forced to see your tax accountant once a year because the IRS and Franchise Tax Board make you, right? But your estate planning attorney, who knows, whenever you see that person, maybe, and I know what people think, the less the better, right? Because every time you come in, it's dollar signs, right? So I understand that point of view. But usually with the investment advisor, you're having at least a few contacts a year, maybe more. But it's something where I really enjoy working with very active advisors who know the family dynamics, who are aware of what kind of asset class holdings the client have, and kind of the trajectory of where things are going in their life. It's also easier sometimes to spot when the wheels start coming off with a client. For example, when I say wheels coming off, I mean everybody ages and everybody gets to a point where they need help. And I think I heard a nurse at Torrance Memorial who was giving a presentation one time say that only about 10% of people die all of a sudden. And that means for the rest of the 90% of us, we're kind of going through a process of incapacity. So there's a gap between being competent and being able to manage finances and then passing away. And in there is a continuum where all kinds of things can go wrong. And so an important part of planning is kind of keying in on when that's starting to happen and then creating ways for the client to be in control as much as possible, yet also receive the support they need to be able to stay in control and manage things. So, you know, a lot of planning will focus on those things too. And with the investment advisors in the picture, it's a way that we can stop problems from starting to begin with.
Thank you, Eric.
Yeah, it
great.
sounds like, oh, sorry.
Go ahead, Angela.
Oh, I was just gonna say, it just sounds like a lot of the problems that people could potentially run into can be mitigated with proper planning ahead of time, and just staying current. You know, there was so many times that I run into clients where they haven't updated their trust for like 20 years, for example, and maybe some of the beneficiaries or even the successor trustees in that trust are no longer alive. And so we always encourage our clients, hey, you know, it's important to continue to revisit your trust. You know, if you don't have a relationship with your attorney anymore, then let's make sure that you do have one that you can and will continue to have a relationship with, because we feel that all of these different moving parts all come together to help. Ultimately, I think we're all in this business to help our clients so that when they do pass away, you know, all the T's have been crossed, all the I's have been dotted, so that the beneficiaries are able to receive what they should receive without having to deal with the trauma of like, oh my gosh, my parents didn't do X, Y, and Z. So I know one of the things that we were going to talk about is the lack of potential problems that might arise from a lack of preparation. I'm sure, Eric, you've had some very interesting situations come up where people don't prepare ahead of time. I know I've seen some of them, and I can talk about that, but I would love to hear what some of the things that you've run across when people don't prepare adequately, and what that might look like.
Oh yeah. Well, yeah, I've seen the gamut of people who, first of all, thinking about death or incapacity that is unpleasant. And some people just have a hard time thinking about it, and therefore they don't prepare for it. You know, they say about 50% of the population passes away without a will or a trust. And, there's probably a good many of those people who don't have considerable assets, but I can tell you that there are people who have a lot of assets who pass away sometimes without an estate plan. I'm
It wasn't Elvis Presley one of those people?
Could have been.
Michael Jackson also.
Yeah, Michael Jackson. Yeah, that's right.
Yeah,
a lot of
Prince,
people.
right? There's I think Prince has more supposed children of Prince keep coming forward, right? So I've heard.
Everybody wants a piece.
Yeah. So yeah, it's a problem that it never really goes away, and there's emotional dynamics all wrapped up in it. And it's not just passing away, but it's also planning for incapacity, like I was talking about. And for people who don't have heirs, planning for capacity. When I say heirs, they don't really care who gets their stuff when they pass away. For them, incapacity planning is an even bigger deal, because they don't want to have a miserable last few years of their life when they are when it gets to that point. So yeah, it's there's a lot of instances and too numerous to count of estate planning disasters I've seen.
So could you just talk about that for one of one more minute, but that is the healthcare directive, I believe, that you're speaking about, right?
Oh, that's one of the planning things that has to be taken care of. So, you know, in terms of incapacity planning, there's two prongs. There's financial planning, which is how to trigger a power of attorney or how to activate those people to step in for you and manage your finances when you can't. And then there's the healthcare decisions, and that's mostly making known your wishes to other people. You know, there's a lot of people who don't have healthcare directives in place. You know, I think it
which is
in
shocking.
in California, it's less than 50%, maybe closer to 20-25%. And then for people who have that set up, a lot of people don't have them with them when they need them. So you know, who drives around, who puts a healthcare directive document in your vehicle and drive around with it? Do you go to the mall and carry your healthcare directive with you? You know, most people don't. So, you know, we have ways to address that. And we talk about that in our planning when we talk about, okay, what happens when you're out and about and you know, someone finds you unconscious, you know, or you're in an accident, you know. So we have ways to address that and get your directive to, you know, the medical personnel. But yeah, all of these issues about end of life, you know, do you want to be in a persistent vegetative state if you're not really likely to come out of that? You want to have heroic measures taken to keep you alive. What about the disposition of bodily remains after death? You know, what do you want to have happen? So all those things kind of, those are all the things we talk and plan for and have contingencies built into your documents to address. But it's a process, and some of it's difficult to think about or talk about. But I try to make it a calm, easy. Try to make it an easy process and help spur people through those discussions.
And Angela,
And I will say, oh,
I was going to
go
ask you, Angela, like from the financial advisor side, you know, and you say some of the problematic areas where you're not preparing enough. I mean, can you talk to or about families that don't really communicate very well and how that could be problematic?
yeah, so I was actually going to touch upon exactly that, Kevin. So thank you. What I was going to say on our side, you know, we may not be dealing with the healthcare directive. Some of the problems for us arise from lack of communication with the children, the adult children. So for example, you know, we've had situations where mom and dad passed away, and during their lifetime, they had gifted a lot of things and helped out one of their children with education, with just extra money over the years. And so upon their death, they actually had an unequal distribution to the two children, for example. Sorry, that's my dog going crazy here. So what they did was maybe one child received 90% in this one case that I'm thinking about, and then the other child received 10%. And the child who ended up receiving 10%, and when I say child, I'm talking about an adult child here, the 10% recipient was shocked and could not understand why his parents left him just 10% versus a sister who got 90%. And it was because of everything that they had given him over their lifetime. And unfortunately, mom and dad did not explain this to him. And it just ended up in a lot of hurt feelings. And basically, the brother and sister now don't talk at all because of that. And I think that's not what the parents' intentions were or their wishes. And so I always tell people, you know, let's make sure that your children understand what is going on. And that's why we think family meetings are very important. We try to encourage that and try to do that with our clients, is making sure that we do a family meeting and just kind of go over everything. You know, if this happened to mom and dad, this is what's going to happen. These are the assets. This is who is going to be the first successor trustee. This is the contingent successor trustee, so that everyone is on the same page. Because no one's wishes are for their children to hate each other.
Right. Very good, Angela. And the one thing I'll add to that also is I would say one thing that a very good financial advisor can do for you is really help you articulate, what does money mean to you? What sort of legacy would you like to leave? You know, do you have philanthropic wishes outside of just your children or outside your family? And just articulating that, maybe prior to going to see the estate planning attorney, helps you kind of walk. We try and really get our clients to be very they know what they want before they go in to see the estate planning attorney. It makes the process so much easier, especially for the attorney. And I'm sure Eric will tell you, he has the same process. But if the people sitting in front of you haven't thought of it already, it kind of, you don't want to think of like all of your philanthropic beneficiaries like right off the, on cue. So sometimes it can be difficult. And one thing that Angela and I do, or we like to do, is when we have a new client that's going in to see an estate planner, we like to go in there for the first 10 minutes and just basically buffer that new relationship, explain to the attorney a little bit about their financial relationship and what they're looking for today. And I think that helps really ease that process. You have anything to add to that, Eric, from your end?
No, I think, yeah, it's really important to, just have, at least get the process done and get it moving, I find there's people who don't do planning because they have a hard time making decisions. And so I tell them, hey, let's just get something down. Perfect is the enemy of good, right? You've heard that saying.
Absolutely.
The perfect is the enemy of the good. So just get something down. It doesn't have to be perfect. We can always change it. Estate plans are always revocable. And when it's time to get a design down, I work off of a template where I know what questions to ask, and I spur people to move them through the discussion. And I always tell them, when they get stuck, I get them unstuck. So it's a process, but yeah, it's always better to have something in place rather than nothing. And if it's imperfect, hey, that's okay. We'll work on getting it more perfect next time.
Excellent.
Yeah.
And then
Oh.
Go ahead, Angela.
Oh, I was just going to say, a lot of times there's various trust mechanisms that can be utilized to minimize, especially estate tax liabilities that might arise. So I was just going to have a conversation with Eric about that. I know, you've got, for those who are unfamiliar, you have the revocable, like family living trust, for example, revocable meaning that you can change it at any time during your lifetime. And then you've got the irrevocable trusts, which are great for families to remove assets out of their estate, for example, so that it's not subject to estate taxes. Maybe, Eric, you can talk with a little bit about some of these different strategies that have been popular or that you have worked on with some of your clients, and what kind of impact that it's had for your clients.
Sure. Well, what most people's goals are, first of all, is to make sure that the assets go to the right people or institutions in the right percentage amounts or whatever the case may be. So getting it, naming beneficiaries is an important thing, and then having a backup plan in case a beneficiary is deceased or whatever. We always try to build backup plans. But then, the next biggest thing, at least in California, that people are concerned with is, how do I stay out of the probate courts? The probate courts in California are still operating off of a California legal code that was created in 1872. So it's ancient, it's antiquated. And so if you go through California probate, it's this very long process that's, in my view, needlessly long and unnecessary to go through for most people. But it has not been reformed in any meaningful way since the 1970s, and even then, the changes they made in the 70s were minor, and so really we're really just kind of working off of a 19th century piece of legislation, and due to that, there are a lot of protections in place for estates that go through probate. So, for example, if you have a very contentious family and there's maybe not a chance for a trust company to be a third-party mediator type of trustee in there, and you have to have a certain number of assets or amount of assets to have a trust company involved, sometimes it might be a good idea to purposefully send your estate through probate, because then you'll have a probate court judge overlooking or overseeing everything. But for most people, that's not necessary. And in that case, you don't need all those protections. You just want to get it done for as easy and cheaply as possible. In that case, you want to have a revocable living trust. Revocable just means you can change it. Living means you've set it up during your lifetime, not at death. You may have heard the term a testamentary trust. That means it's created at death under your will. So a living trust means you just created it during your lifetime. So most people, the vast majority of people who do estate planning, they want to set up a revocable living trust to do the two things of transferring assets to the next generation or their beneficiaries without a probate. And they want to also do incapacity planning for their potential incapacity, as we just talked about.
Very good. Angela, you have anything to add to that?
I was thinking that maybe we can talk a little bit about the Tax Cuts Job Act and the sunset that is coming up. I know it's something that is very popular, I think, for example, so Eric and I both belong to the South Bay Estate Planning Council. It's definitely a hot topic amongst our peers. I don't know if that's necessarily the case in other industries. I know it definitely is something it's constantly on all of our minds. And in case you guys are not familiar with what this is that it is the estate tax exemption amount that is due to sunset at the end of 2025. So starting in 2026, it will revert back to what it was previously. And I believe that number is going to be adjusted for inflation closer to about 7 million per person, versus right now we're at about 13.6 per person for the exemption amount. So that just means that a lot more people will be subject to estate taxes when that sunset happens. Am I right about that, Eric?
Yeah, so whether the sunset actually occurs is maybe a 50% chance, because Congress and president could change things. Maybe it depends on who gets elected coming up. But that could always change. And so I'd say just keep track of the news, or keep track of your newsletters from from your professional advisors and all that. But yeah, I looked up the exact amount as of today, as if the Tax Cuts Jobs Act would be eliminated or reset as of today, and that number is 6.9 million. So as of January 2026, I think it's probably going to be around 7 to 7.5 million range, depending on the inflation. It's keyed to $5 million as of 2012, but adjusted for inflation. That's the exact formula. And so I honestly, it's a big issue for some of the bigger estates for sure, because some people can gift money. They can max out their gift tax exclusion amount, which is close to 14 million now. And then when 2026 hits and that exclusion amount goes down to 7 million or so, the IRS will not claw back the 7 million they already gifted. But I would say most of it, for the vast majority of people out there, they don't fall in that category. Maybe this this is a topic for maybe the top 1 or 2% of people out there. But I would say you'd have to have maybe 20 or $30 million in the first place before you'd want to really make giant gifts like that to drain your estate down. But yeah, I wish I was in that category.
Yeah.
I'm not in that category.
So Eric, one additional question to that is if they put $10 million into an irrevocable trust, is that a gift? Is that considered a gift to get it out of your estate? Or I thought in that case it would just be out of your estate, but is that considered part of a gift?
Yeah, so if someone puts 10 million into an irrevocable trust, and assuming that trust is drafted correctly, then that would be considered a gift. And so the person would need to file a gift tax return. No gift tax would be due if they haven't exceeded the 14 million amount. But it would, they'd have to let the IRS know, and then that 10 million would be subtracted from how much they could pass away with. So let's say that they pass away in 2026 when there's a $7 million limit. Well, they've already gifted 10 million out, so it's not like any taxes due. That 10 million was gifted out. The IRS won't try to claw any of that back. In other words, you don't have this negative balance that suddenly you owe tax on. And we were all worried about that for a few years, but the Treasury Department released some stuff on that basically said there's no clawback. So we're good.
Now, I know that for, so one of the things that I've learned about in the last few years, that one of the strategies that a lot of estate planning attorneys will use is maximizing maybe one spouse's lifetime exemption amount. And then that way, if and when it does revert back, you've already used up that, 13.6 million from spouse number one, and then now spouse number two, if it reverts to 7 million, now you still have that 7 million. Is that still a pretty popular strategy in 2024?
So yeah, I mean, assuming that that's a stable marriage and that there's no problem,
which is like a 50-50 shot, right?
Yeah.
Or you can divorce them and then get remarried to them.
Yeah, and also you see a little bit less of that in California because we have community property here, and so spouses jointly own all these assets as community properties, and they tend to not set up separate estate plans. They might have it all running through one trust, but in other states where it's not community property, you have the spouses each have a trust, and one might set up what's called a spousal lifetime access trust. So they'll basically gift their exclusion to the other spouse, so they use it all up. And then, usually you have spouses that gift things to each other, and it's reciprocal, so that if there is a divorce, they just end up with whatever they have. But it's, I'd say if you're in the 30, 40, 50 million range and you're worried about that, get that straight, maybe talk about that strategy. But you don't want to gift away everything you have either. You want to have control. There's also downsides of doing all this radical gifting, is that typically there's always a downside to doing a strategy, and usually you pay for it in the capital gains area. If you're doing estate tax planning, there's kind of you lose an advantage in the capital gain side, and if you take an advantage in the capital gain side, you lose the other advantage in the estate tax and transfer tax arena. So you have to kind of weigh the balances and say, is this a smart thing to do? But when it comes to taxes, what I see the most for people in California these days is property tax planning. So
right.
We have income tax planning is important in estate planning, especially with blended families. You have trusts that might create protective trusts if one spouse dies versus the other, like a bypass or exemption trust. And, used to be set those trusts up and there'd be definitely a capital gains disadvantage from having those trusts around. Well, now we can design them so that we can take away that disadvantage. So we've got some nice tax bells and whistles to take care of those issues. But property tax planning is a big area where we want to make sure things get covered the right way. And, it's one of the biggest issues is families who are real estate rich and cash poor, and they have, the biggest asset is the family home, and all the children want to have that as their home to live in. And, maybe it's figuring out which kid should get the option to live there. But if you plan that the right way, and this has to be done the right way in your living trust. If you don't plan for it, it can be an expensive estate settlement getting that sorted out without creating a property tax reassessment. All we have to do is just put a few magical words in your trust document and the problem is solved, assuming your kids get along. So there are definitely property tax angles to work there. Also, if you purchase investment property, make sure you form an LLC first and have the LLC purchase the investment property rather than you purchase it in your names and then put it into a LLC later. You always want to purchase it with the LLC first if you can. Sometimes there's lender problems with that, but if you can get around that, that's
it seems like
my advice.
Why
seems like
is
all
it
the
that you would want the LLC to buy it first
It
instead
makes
of having to buy it individually and then putting it into the LLC?
It makes no sense, but there's just different laws for property tax reassessments based on if the LLC purchases a property versus if an individual buys it and then puts it into an LLC later. It's just a different set of rules altogether. And and who knows why. I don't know if it was intentional, but that's the way it's written in California's revenue and taxation code.
I'll bet it's because the regulators think that you're trying to do some sort of tax scam or, evasion type of maneuver there. And the one thing I was going to say too is that the lenders, right? If you're taking a loan on the property, they always want you to do it in individual name and then switch it to however you want afterwards, because that's the way your taxes are done and the way everything is laid out. It's a lot cleaner for them to have you qualify for a loan, especially if it's a large amount. But it's really problematic as the new owner, right? You're not protected right off the bat. And if you delay, sometimes you don't go back and get that changed over or get the title quit claimed into the proper name to protect yourself. So it's kind of a double-edged sword.
Yeah, before anybody goes out and gets a loan against their property, especially if it's an investment property, I recommend that they just talk to some of their tax advisors, attorney or tax accountant, or maybe a combination of those just to make sure. You see a lot of disasters happen with lenders who they don't know the big picture of what's going on and they just want to get the deal done, and it's easier for underwriting to do it a certain way, and so they do that, and then meanwhile they create all these potential issues down the line. And or I even saw a situation a couple weeks ago where they forgot to put the wife on title to the house, so it was just the husband's name, and we were double checking them and we saw, hey, the lender, you guys forgot to do this. So yeah, it's big problems later on if something wrong.
Hey, Eric, one other question I have too is, can you briefly discuss you mentioned buying something in an LLC. What's the advantage of buying it in an LLC versus, like, say, in the trust name? And who commonly has an LLC versus just like a family trust or something of that nature?
Yeah, so the purpose of an LLC is to provide a little anonymity on the deed. Because if you purchase something in an LLC, you can't really see who who the purchaser is. So that provides some anonymity. So if you're a celebrity, sometimes, you might want to do that. And then also, if it's in an LLC, you have asset protection to some degree from creditor claims that might arise on the property if there's a slip and fall on the property, or
Right.
whatever happens, that liability stays with the LLC and doesn't go outside of that to your own personal assets. And then from a property tax standpoint, if at least if the LLC purchases the property, then it can be transferred to completely new owners at death or at time of gifting or whatever, or sale. It could be transferred completely without property tax reassessment, which makes the property more valuable. If you can tell these new buyers, hey, I've had this property for 20 years in this LLC, and the property taxes are now pretty low based on market values today, and you get to actually take those low property taxes, that's going to increase the attractiveness and the purchase price on that property. So that's assuming that all happens the right way. Now, if you bought it and then put it into the LLC, again, different rules apply, and you wouldn't be able to transfer that to a new buyer with the lower property tax base.
Thank you, Eric. Angela, I'm going to throw you a softball now. Can you describe what happens when, say you're meeting with a new family or a new individual, and they come to you and they have decent or significant assets, and you see that they don't have a trust set up, and they basically have money, but they haven't really done any sort of preparation. What do you tell them? What happens next? What sort of steps do you take? And then, I know we talked initially about collaborating with the estate planning attorney, but how do you go through that process with them?
Well, we go through a get to know you phase. I would say the first meeting is where we are getting to know the family and having an understanding of what it is that they, first of all, the raw data, which is like their assets, collecting all of that data, and then also having a discussion about what's important to them. I know earlier we talked about values. And so a lot of times families with wealth want to make sure that their children carry on their values. They don't want their children to grow up to just spend the money, all the money that they had earned over their lifetime, or maybe it's over several different lifetimes. And so we just continue to get to know the client and figure out what exactly it is that they're trying to accomplish. And during that process, we might be able to assess what is the best course of action for them in terms of if they don't have a trust. Obviously, they need to start with that, first of all, to make sure that they are protected and not going through probate, because we all know that that's a nightmare in most cases. So that's kind of what we would go through. I don't know if that, hopefully that answered your question.
Yeah,
but that's when we would bring in somebody like Eric, who I can trust our clients with, to make sure that he is able to do the right job. Well, we know that he'll be able to do the right job for our clients. So that's very important. But, one of the things that we've been, kind of going back to things like I know we were talking about the lifetime exemption amount. We've been, I think the gift amount for 2024 is $18,000, which you can do without even touching that lifetime exemption amount. So right now, for our clients, what we're suggesting that they do is start gifting. That's $36,000 for a married couple. So we have a lot of clients who have started doing that for all of their family members, which is just yet another thing to do, especially if you know that you're not going to need all the assets that you currently have, and you already have a nice income stream coming in from maybe source A, B, and C, and you have X, Y, and Z that is just on growth mode, and you don't need that to live off of. then maybe you start gifting from the XYZ assets. It's a very, very powerful way to give money to the next generation, because ultimately that's what a lot of parents want to do, is making sure that their children are well taken care of even after their death.
Thank you, Angela. Eric, I kind of have a
Yeah.
follow-up to that one also, is when someone comes to you, and I don't know how often this happens, and they talk about their retirement plans or their individual retirement IRAs. When you suggest, because I see this a lot in dealing with clients that have just come back from the attorneys. Traditionally, they'll have them put their spouse as the primary, and then the trust as the secondary or contingent beneficiary. Is that a common practice? I mean, in general, we always direct them to do the primary, the spouse, and then the children, if they have them, to be named beneficiaries. So can you just briefly walk us through what the difference there is?
Yeah, yeah, I agree with that approach. Generally speaking, you want to name the spouse. There's always exceptions, but the spouse will be able to take retirement plans in there, and if they're designated directly, then they'll be able to, have the benefits of rolling that over, and there's good tax benefits to doing that when the spouse passes. And then, in terms of contingent beneficiaries, if the children or whoever are old enough and responsible enough, generally designate the children individually. If there's a compelling asset protection concern that, if there's a substance abuse issue, if the children are minors and can't hold title in their own names, then maybe, you might want to think, okay, naming that child's trust share as a beneficiary, not the trust in general. I don't really recommend naming it just, the Smith Family Trust as the contingent beneficiary. The way I like to do it is to make sure that each beneficiary's trust is specifically named as the contingent beneficiary, and the reasons why, are income tax based. You don't want to mess up the income tax stretch on an inherited IRA that goes through a trust. If that's handled the wrong way, it could create problems. So the best way to deal with this is not run it through a trust at all if possible. The second best way is run it through a sub trust, and not the family trust, but a sub trust created for the child, and go from there.
I
Excellent.
think that makes a lot of sense, for sure.
It does. Angela, you have anything to add to that?
Well, I think it's great to have the sub trusts for the children as well, because it protects them from any future spouses that might try to lay claim to what is technically the family's assets. I certainly don't want whoever my children marry to have access to my family money. I want it to go down my family line, and I think a lot of parents feel the same way, because you just, as we discussed earlier with marriages, you just never know. With divorce rates as high as they are, you just never know if that marriage will be stable. So you definitely don't want some random person that your child married take off with half of their assets.
Yeah, and we can certainly set up trusts that would go for a beneficiary's lifetime. And then the question to the client is, at what age would you like your child to be able to control his or her trust?
Never.
So hopefully if they're responsible, and that goes back to family dynamics and what do we look for in planning. And, we're seeing more and more today kind of a failure to launch syndrome with children, where they might stay living at home and not going out and establishing themselves, and not really taking care of themselves financially. And so I think, financial literacy, teaching children, encouraging them to strike out on their own at certain point in life, hopefully right after high school or so, or in the college years. And, and then also, what we also look for is we look for neuroatypical behavior or neuroatypical personalities. So we look for mental illness type issues. We look for ADHD and autism, and we look for personality disorders. About 9% of the population in general has personality disorders. So when I talk about that, that's narcissism, histrionic, psychopathy, borderline personality, and antisocial behavior. I'm not a psychologist or a psychiatrist, but being in this business, I see patterns, I start to see things, and I'm able to help clients plan for those contingencies and say, what can we do to give this person the best chance of success and not create a problem? Just a quick little story. I once represented a family, and it was not a family, but a successor trustee for a family trust. And there were 5 children. They were all going to receive equal shares, but none of them liked the trustee. And then all the children wanted to be the trustee. They didn't want the other ones to be the trustee. They all had personality disorders. They were all nice people.
All of them did?
They all had personality disorders. So they all hired lawyers to fight with each other. And in that case, you find 2 kinds of lawyers. You find the type of lawyer who wants people to get along and say, hey, let's work this out, and kind of maybe strong arm their client to say, hey, be reasonable here, let's work this out. And you find other lawyers who are kind of just hired guns and just do whatever crazy stuff that their client says them to do. And I like to think that I try to strike a balance somewhere in the middle, but I tend to be more toward like telling my client, hey, you got to be reasonable here, instead of just being the hired gun. As a result, this $2.5 million estate or so was spent down all on lawyer fees, so that each child ended up with $50,000 each by the time it was done, 5 years later. And so $50,000 was all they had to show for it. And
I wish your example had a better outcome, but it does show the troubles with, failing to plan, right? And taking the right steps and walking through it through the years. I think that's all.
That's really sad. Yeah.
Content. I'd like to at this point go and put a few of the questions that we received out to the panelists. Angela and Eric, you guys have been amazing. Eric, you're a wealth of information, and Angela, you just know this so well too, inside and out. We really appreciate it. The first question I have is, and I'll go to Angela on this. Is there a certain assets or thresholds that you need before it makes sense for a family or an individual to even have a trust?
Well, I think everyone with assets, at least $100,000 or more, which is pretty much everybody, needs to have a trust, because otherwise you're going to go through probate, and probate costs are anywhere from what I understand in California, 3 to 5% of the value of whatever assets you own. So everyone needs one.
So about $100,000. If you have assets over 100,000, you probably should have a trust. And we always say too, it's life events that really should prompt individual or couple or a family to. A life event could be getting married, purchasing a house together, because then the assets are getting bigger quicker. And Eric, I'll go to you on the next one. When planning my estate, will I know how much will be passed down to my children? What kinds of things happen after death that diminishes what I pass down? And how do I minimize those things that diminish it?
Well, that's basically what my job is we first get a baseline of what you own. So we get, we basically work up a balance sheet that has a list of everything you own and how you own it. And so based on that, we kind of know what we're dealing with. And then the estate planning process involves figuring out, okay, should this go into the trust? Should this pass by beneficiary designation or some other means? If it's an annuity contract, maybe it goes by some kind of beneficiary designation in the contract. sometimes there might be contractual limitations as to how it could pass. If it's a 401k type plan, then maybe it has to go to the spouse unless the spouse waives it. There's all kinds of real wrinkles. So we have to get a complete inventory of what you own and how you own it, and what the value is in order to do a good job. And then we go from there. And part of our process, what makes us different from other firms, is we actually build out that list of assets, and we address each one, and then we help you change the title. We keep tracking that for years going forward. We actually have a program that we call Family Office Program that actually does that, and it would work perfectly with your advisor at Angela and Kevin. When they check in with you, we do our part to kind of check in too. So it's kind of supposed to kind of a seamless type of system that works well. Yeah, anyway, just knowing what you have and then saying, okay, what's going to be taken away when you pass away? Is there estate tax issues, income tax issues, property tax issues? Are there other fees and costs? And usually we're able to figure out exactly what's going to happen if we know what you own and how you want to get it to the people you want to get it to.
Excellent. Eric, I need a 1-minute answer to this one. Can you touch on the step up in basis on inherited assets versus the tax treatment of something that
of gifted during lifetime?
Yes, exactly.
So, okay, so if you give something during a lifetime, the recipient takes the basis that you gifted, the basis of the asset, meaning the cost of the asset. Let's say you purchased property for $100, you gifted it to, and it's you purchased it for $100, it's now worth $100,000. If you gift it, it still has that $100,000 basis, most likely. Versus if you pass away with it, under the tax laws, everything that you die with gets a adjusted tax basis to market value that's going to be higher. So that's $100,000. That's much better for your heirs because when they sell it, they don't pay capital gain tax. So
thank you so much. Well, you guys have both been amazing. As I said earlier, I want to tell the viewers out there also that both Angela and Eric are very accessible. You can look them up online, would be a great way to search for them. Eric's at Pacific Coast Legacy Partners, and Angela is Tortuga Wealth Management. We will have this entire webinar. It is recorded, so we will be able to send out replays if you wish, or you can share it with people. We do have another webinar that's coming up in 2 weeks. It also will be once again on an estate planning topic. So we're super excited about that.
And once again, charitable emphasis.
Okay, exactly. You want to explain that a little, Angela?
Yeah, so in 2 weeks, it'll be our final webinar for the summer series. And we will be talking about charitable gifting strategies. Everything from maybe charitable remainder trusts and other ways, whether it's an endowment or family foundations, donor advice on different ways that you can give charitably while leaving a legacy behind and helping your community. It's the best of every single world. So we're very excited for that as well. So thank you.
Thank you, Angela. And Eric, any specialties or anything else that you want people to know about your practice?
Well, just that we don't want it to be just a transactional thing where we take as much money as we can to do as the least amount of work. You encounter that all throughout life, right? Everywhere you go. We actually want to provide value, do a really great job, and be people you can count on, someone you want to communicate with and talk to, and not feel like, oh, you're on the clock. We're accruing this big giant bill. We want to just lay out all the expectations and have an ongoing relationship. That's the way we like to do business.
Well, thank you very much to both of you, and thank you for joining us for this webinar. And we'd love to see you in 2 weeks. And please feel free to reach out to Angela or Eric at any time. Have a great day.
Thank you.
Bye.